In today's video, I want to walk you through what I believe is the most underreported financial crisis unfolding in America right now. Across the country, office buildings that once housed thousands of workers are sitting completely empty. Lobbies abandoned, floors gutted, lights off. The national office vacancy rate just hit an all-time record high of 20.7%. That's worse than the peak of the savings and loan crisis in the early 1990s. Before the pandemic, office vacancies were around 16.8%. Today, 1 in 5 offices in America sits empty, and the trend line keeps climbing. And it's not spread evenly. Seattle and Austin are ground zero with vacancy rates above 27%. San Francisco sits at nearly 26%. Why? Because roughly 66% of US companies still offer hybrid or remote work. Physical office occupancy hovers between just 50 and 55%. The work-from-home revolution didn't reverse. It became permanent. And that's hollowed out demand for traditional office space across every major metro. Now, here's where it gets really interesting. The market is splitting in two. Brand new premium buildings with rooftop terraces and modern amenities maintain just 12% vacancy. But older commodity office buildings, they're flirting with vacancy rates above 30%. The Urban Land Institute says 45% of buildings over 20 years old need major upgrades just to survive. These aren't just empty buildings, they're stranded assets. Massive parking lots with no cars, suburban office parks turning into ghost towns. But the vacancy crisis is just the beginning. The real bomb is the debt. Nearly $1 trillion in commercial real estate loans came due in 2025 alone. Another $875 billion to $936 billion comes due in 2026. And by 2027, S&P Global Projects maturities hitting $1.26 trillion as deferred loans pile up. Here's the problem. These loans were taken out when interest rates were 3 to 4%. Now borrowers face refinancing at 6 to 7%. The math simply doesn't work. A building that comfortably covered its mortgage at 3% can become instantly cash flow negative at 7%. So what have lenders been doing? They've been playing a game called extend and pretend, granting 1 to 2-year loan extensions, but rates didn't drop fast enough. And all that strategy did was push the problem into 2026 and 2027. Analysts are calling 2026 the sorting year, where lenders can no longer kick the can. The distress signals are already flashing. Office-backed CMBS delinquency rates just spiked to an all-time high of over 12%, surpassing the peak of the 2008 financial crisis. And remember what happened to regional bank stocks in early 2023? Silicon Valley Bank, First Republic, they collapsed. That instability is directly tied to what's happening now. Now, here's where it gets really dangerous. Who holds most of this commercial real estate debt? It's not the big Wall Street banks. It's your local community and regional banks. Community banks represent just 15% of total banking assets, but they hold 29% of all commercial real estate loans. Over 30% of them are classified as CRE concentrated. Federal regulators flag any bank whose commercial real estate loans exceed 300% of their equity. A 2025 analysis found some mid-sized banks have CRE to equity ratios as high as 600 to 900%. That means if their real estate loans go bad, they could be wiped out entirely. And it gets worse. These same banks are sitting on $395 billion in unrealized losses on their bond portfolios, a legacy of the Fed's aggressive rate hikes. Here's the death spiral. A bank forecloses on a bad real estate loan, takes a massive loss, then has to sell its underwater bonds to raise cash, crystallizing those paper losses into real ones. That's exactly the death spiral that brought down Silicon Valley Bank and Signature Bank in 2023. The FDIC warns severe CRE losses could exceed equity for hundreds of smaller banks. When enough loans default, banks are forced to slash their lending. Small businesses can't get credit. Local economies starve. The pain radiates outward from every failed loan. Foreclosed properties get auctioned at fire sale prices, dragging down values of every building around them. Tax bases collapse. Cities lose the revenue they need to function. This court-ordered auction in Ohio tells the whole story. A 64,000 square foot office building appraised at $2.5 million, going for a reserve price of $1.7 million. That's the new reality. Now there are some bright spots. Manhattan's vacancy rate is just 13.6%, driven by Wall Street's return to office mandates and demand for premium transit-accessible towers. Private credit funds and alternative lenders are stepping in where banks are retreating, providing rescue capital to bridge the valuation gaps for distressed borrowers. Some developers are converting obsolete office towers into residential apartments, buying buildings at 60 to 70% discounts and completely reimagining their use. This office-to-residential conversion in Massachusetts shows what's possible. 10 new apartments, ground floor retail, and a revitalized streetscape from a building that was gathering dust. But make no mistake, this is not 2008. It's more targeted, more slow-moving, but for hundreds of regional banks and thousands of property owners, it is an existential crisis. $2 trillion in debt coming due. 20% vacancies. And the banks that hold this debt have the thinnest margins in the entire financial system. The clock is ticking.